So I've been slacking for a while now. My colleagues have been making these wonderful industry presentations. So some people were ostensibly missing me. I don't know whether that was to make me feel good or to be regular in attendance here. Nevertheless, so today it's a slightly longish presentation in terms of number of slides. So I'll go through them quickly. Most of them are pictorial in terms of charts. Uh, and the second part will be some of the medium to longer term trends. We have spoken about them in the past as well, but we will just uh, take a status update on that as to where we stand today and how things are going on that front. So let's dive into this. Let's talk about equity markets. So the narrative currently is what happens now. Are we going into a recession, not going into a recession? Is it a new bear market or is it a bear market rally that we have seen after the fall, the recovery that we have seen? Uh, so just to give context, this is how Nifty has done. So leaving aside the ups and downs, we are 43% higher than the pre-COVID levels in roughly 2.5 years, which is more or less what equity markets do in the medium to long term. So uh, it's not that it's something unusual. The fall was very, very steep. There was a recovery which overshot on the upside, and we have given up some of the gains. But broadly, if you are a longer term equity investor, uh, and you have not been watching the stock indices or stock prices or the NAVs on a daily basis or on a monthly basis, you would be wondering what the fuss is all about. If you just even out the uh, journey, it's more or less what is normal for equity markets. Again, so much of fuss is being made about interest rates. They've gone up, and what will happen to valuations, and what will happen to the economy, and stuff like that. And these are not even very, very long term charts. Uh, I have personally seen government bonds paying 14% per annum semi annual, AAA corporates borrowing money at 18% per annum, and AAA NBFCs borrowing money at 21% per annum. So if we are at roughly 7 quarter, 730 yields on 10-year government bonds, this is something which we have seen within the last 5 years. So 2018-19 is when we have seen similar interest rates. So again, what is the fuss all about? Same thing for US interest rates. It's the low interest rates that we saw a couple of years back, that was the anomaly rather than the current interest rates being an anomaly. It's just that the uh, COVID shock was so great, or the urge to avoid recession and to ease the pain for people was so much that interest rates were kept at very, very artificially low levels. And we are more or less in normal era. So when I say this to people, saying that interest rates are more or less okay, why is this fuss about equity markets are more or less okay? So the pushback that I get typically is that, but you know what happened in the US in 1980s? Inflation went haywire. Volcker had to hike interest rates. Do you know what happened to India in mid 90s? Inflation is the biggest worry. So that is the pushback. So rather than absolute levels of interest rates or absolute levels of equity indices, what people are most worried about today is this. So let's look at that in context. To my mind, there are only two things which are relevant here. When COVID hit, what did governments the world over do? They said, stay at home, don't venture out unless it's absolutely critical. So, firefighters, police, medical professionals can go out, everyone else stay at home. no offices, no factories, no shops, nothing. So there was a tremendous supply shock. The after effects of that are still being felt the world over. That was one part. Second, people started screaming, how will we feed ourselves? Governments said, no worries. Governments and central banks, we will give fiscal support, we'll give monetary support. Moratoriums, interest rate cuts, free ration, free gas cylinders, free stimulus checks in the West. So what happens when you cut out production and supply and when you keep the demand intact? Initially, what happens is inventories run down. After inventory is over, you have shortages, right? It's pure and simple that I don't think there is any other way to read this. Just look at this. So, to transport one container from the east coast of China to west coast of US, it would cost roughly $1,400. This is pre-COVID. That had gone up to as much as $12,000. Why? Because container ships were stuck at ports. If they could unload on the ports, there were no truck drivers to take the containers to the destination. There was shortage of container ships, there was shortage of containers, and all sorts of bottlenecks were there. So this is one manifestation of bottlenecks. Crude oil, briefly in the futures market in the US, they traded at negative prices. But there was a big drop and then a big spike in the crude oil prices. Again, not just COVID, but the war which is there, Russia-Ukraine war. Again, as a result of war where gas supplies have been curtailed to Europe, huge spike in energy prices. So what used to be somewhere between $4 to $12 in that range has suddenly gone up to $57 now, the LNG price. This is what has happened to coal since natural gas is not available at a reasonable price. People have started burning coal again, and countries like Germany and all had shut down their nuclear plants. Gas is not coming from Russia. So, what is to be done? And what used to be less than $900 billion prior to the global financial crisis went to $9 trillion. So, tenfold increase in US Fed balance sheet. So, when such a huge thing happens where you have huge supply shocks, you have huge amount of monetary stimulus, obviously you will have inflation. So the question is not again what led to inflation. If we just scratch below the surface, the answers are right there staring us in the face. The question is what happens in the future. Should we be worried about all these things, and should we be worried about our equity investments? I'll just go back to a couple of slides. There are two interesting things in this graph. One, of course, is from 1400 to 12,000. The other interesting part is the journey down for container shipping rates. Even in crude oil, what went up to beyond $120 is now mid 90s. Let's look at another shipping index. This is for bulk commodities. Here the thing is even more dramatic. So huge shortage, but we are back to almost median levels. There's hardly any shock over here in terms of shipping bulk commodities. Iron ore, big crash from peak levels that we have seen. Copper, although somewhat elevated, but well down from the peak levels. Aluminium, again slightly elevated, but more or less where you were in 2019. Uh, one would prefer as a consumer lower prices, but nowhere near the peaks that we have seen in the past. Wheat, which was the big worry because of the Russia-Ukraine war, again significantly below the peak levels. People who track FMCG companies track this a lot. Palm oil, which is a input for a lot of FMCG companies, again see the crash from the peak levels that we have seen. So the headlines that we keep seeing about inflation and interest rates and all that are yesterday's stories. They are not stories that we will read 6 months from now. That is my understanding. Again, even refining margins, which had gone up very, very dramatically, are down now. So I think this is something which is very, very interesting to keep in mind when people talk about all kinds of shortages. So people talk about semiconductor shortage, right? The Taiwan economic minister just put out a statement saying semiconductor volume growth year over year for Taiwan is 40%. They've just put out this data 2-3 days back. So Taleb says that I have seen gluts which sometimes may not be followed by shortages, but I have never seen any shortage which is not followed by a glut. What we are seeing currently is the impact of huge supply chain shocks. Some of them have already corrected, some of them are in the process of being corrected, some of them may take maybe 6 months, 12 months to correct. In any case, once sufficient enough time goes by where your year on year comparisons start looking back at a higher base, because of the base effect, the inflation rate automatically comes down. So hypothetically, let us say crude oil remains at $100. Now, when crude oil goes up from 80 to 120, that time there's a big inflation shock. But after sufficient passage of time, if crude oil is at $100, comparison becomes $120. Then automatically the inflation rate optically starts looking lower. So I am not in the camp that thinks that we are going to see runaway inflation and double-digit interest rates and stuff like that. The interest rate peaks will come sooner than we expect. Maybe it has already come in a lot of economies. So, long story short, I don't think there's anything exceptional about the equity markets, despite all the hype and hoopla that we see in the financial media and on TV. Valuations are maybe slightly elevated, but neither in bubble territory nor in extremely undervalued territory. You have to be selective about what you buy. Interest rates are more or less normal. Prices of various things are more or less normal. Some shortages are there, which are at somewhat elevated levels, but almost everything is coming off from the peak levels that we saw in terms of prices, and the bottlenecks are easing out. So that's as far as the markets go. So that ends one portion of the presentation. I don't want to spend too much time on it. Jeff Bezos has this favorite saying. So he says, people keep asking me about what are the things that are going to change in retailing in the coming decade. He says that's a wrong question to ask. I don't focus too much on what are the things that are going to change. My focus is on things that are not going to change. So in retailing, people will never say your prices are too low. I wish your prices were higher. That is not going to change. Consumers will always want lower prices. He says Customers will never say that your shipping times are too fast. I wish the delivery would come slower. Customers will always want quicker delivery. They will always want a wider variety of choice. They will never say, oh, there are too many options on your website. I only wish there were fewer items available. So he says these are things which are not going to change. So the second part of the presentation, we are going to talk about things which are longer term in nature. So I don't think as equity investors we should focus too much about uh, inflation, interest rates, commodity prices, and things like that. We are better off focusing on things that will work over next 10 years, 15 years, 20 years. We will talk about two of such things which we have already covered in the past. We'll take something of a status update on those trends. The first big chatter that has been going around is the decline in prices of tech stocks. So, decline in Nasdaq and decline in Alphabet, Amazon, Microsoft, uh, Netflix, Facebook, all these kind of companies. So, is that really the case? Let's look at this. So, while seemingly the prices have crashed from year to year and there's a small rebound, but pre-COVID, this was the level. In dollar terms, the index is 37% higher index, Nasdaq. So again, like everything else, there was a big crash downwards, rebound was overdone, and some of the excess gains are being given up. I don't think there is anything which is exceptional in the way the stock prices have moved for some of these profitable technology companies. Clearly, the environment is not of one of free money where we are in zero or negative interest rates, or where free money is available from venture capitalists and things like that. So the non-profitable tech is going through its own cleanup exercise, but otherwise, some of these profitable companies, they've seen drawdowns as much as 70, 80, 90% in their history. And as long as the underlying business is more or less okay, I don't think we should focus too much on the uh, ups and downs that are happening in these stock prices. Uh, Net net, leave aside the stock prices. If we look at the core business, is there anyone in this room who believes that the future is linear TV, where you sit in front of the television set, you press the button on the remote, and you wait for the channel to telecast something at a particular time, and you will watch that serial only at that time? Is anyone in this room who believes that is the future? Unlikely, right? People want to watch what they want when they want. They will watch it on a device of their choice, whether it's a cell phone, whether it's a tablet or a large screen TV. They either want to binge watch or they want to watch part episode and catch up later. So streaming is definitely winning over linear TV and linear radio. Digital, what was only on in terms of search ads, is gone to large screen TV, even for brand building. So if uh, you guys are watching YouTube these days and you don't have the premium plan, just look at the number of irritating FMCG ads that you see. Lever is a big advertiser on something like a YouTube these days. So I think the addressable ads are the way forward. And again, the younger generation, uh, let's say someone of my daughter's age, a 18-year-old, you can't reach that person by uh, advertising on ZTV, for example. You have to reach such people either on Instagram or on YouTube. So that is the future. So again, cloud computing is winning over the on-premise servers. E-commerce gained very rapid share in the COVID period, is giving back some of the gains, because obviously in COVID, 100% share went to e-commerce when physical stores were shut. When stores open, the some volume will be taken back by the physical stores. But the longer term trend of shift from physical stores to online, that continues. So I don't think fundamentally anything is different as compared to what we were earlier. So that brings us to the energy transition piece, which again is a multi-decade thing, and by some estimates, it is going to require $100 trillion investment worldwide for this shift to happen. This shift is from fossil fuel energy to renewables and from uh, internal combustion engine cars to new energy vehicles. So this transition is $100 trillion transition which will play out over the coming decade or two. So we have spoken about this in the past. Let's just take a look at where we stand and uh, how are we in that trajectory. So again, none of this is very new. So we have seen the Reva electric car on the road for maybe more than 10-15 years. The solar calculators were there when I was in school. Windmills have been around for 100 years. What is interesting is that the pace of change has accelerated over the years. And again, we have referred to Tony Seba and uh, his work on in this space. And it affects a wide variety of companies which are listed in India. Uh, so, uh, if you look at the companies which were listed in Sensex in 1980, and you look at the Sensex composition today, you will find a very different uh, set of companies. So, while those companies may not have gone away, but they are nowhere as close as important as they were in back in the day. So at that time, you had Gwalior and Century and those kind of companies, which are not very important companies today in terms of the large cap indices. So something similar may play out over the next 10 or 20 years, where some of the big companies either make the transition and continue to remain successful, or they get replaced by some of the newer companies. What has changed over the last so many years is what used to cost $76 in terms of the uh, panels to convert solar energy into electricity, that fell to somewhere around 30 cents in 2015, and today it's around 26 cents as per the latest prices. The battery prices have been coming down, so it's because of the economics that the time is opportune for the transition. Not that any of these technologies are very new. They have been around for a really long time. This also has a big impact on geopolitics. So far, despite having a good demographic situation in India where we have a young population, educated people, despite people working reasonably hard, we have been energy deficient, and uh, we have to spend billions of dollars in terms of importing uh, crude oil and petroleum products and other energy forms to India. A decade or two out, that changes. So if we are able to shift transportation to electricity and reduce our import bill, then it has a big impact. And all the resource rich countries right now, which have created these scarcities and wars, where currently the energy prices are very high, those people are in fact accelerating the transition towards newer forms of energy. Just for context, today if you have a mid-sized sedan in Mumbai, and if you get your tank filled, uh, it would cost roughly around 4,000, 5,000 rupees to get a full tank of fuel. Electricity prices, let's say if we assume 3 to 4 rupees per kilowatt hour, per unit. The biggest Tesla cars have a 75 kilowatt hour battery. Even assuming 4 rupees a unit, you can fill up your car effectively for 300 rupees. So that is the extent of difference in terms of running cost that is there in terms of the fuel cost. Now, this is not happening tomorrow or day after. Obviously, there is going to be a transition period, and obviously, capital costs on electric cars are currently much higher than petrol cars. So, you really have to work out the economics, and charging infrastructure has to be solved. But we are seeing the results on the road. So we are seeing in our own city so many electric buses. We are seeing so many Tata EVs running on the road. Some of the Chinese brands like MG Hector and all on the roads. So it's not a question of if, it's a question of when will this happen. And if you are optimist, you may say it may happen in 5, 7 years, 8 years. If you are pessimistic, you may say it will take 15 years, 20 years. But this will happen. So earlier the choice was between having low cost electricity and having dirty air versus having high cost electricity and having clean air. Now that dilemma is no longer there. So given that the current tenders which are coming in, the electricity plus storage sometimes is very, very comparable to fossil fuel prices. So the last tender or one of the recent tenders that was there was at 3 rupees and 10 paise per unit. And uh, eventually we'll have a time where solar electricity is cheaper than fossil fuel electricity. What this is, however, creating is, given that some of the renewable sources are intermittent, it is creating big intraday price differences. So solar obviously is available only when the sun is shining and not at night. So in these summer months, you had this kind of price difference. In June of this year, uh, at night it would be 12 rupees a unit, and uh, morning 9 a.m. it would be less than 3 rupees a unit. So uh, this is the challenge, because so far we have not been able to solve the storage problem at scale. Uh, with monsoon coming in, this problem got resolved for a bit. Now again, of late we are seeing some signs of again supply bottlenecks after this. Some of the bans which came in on some states from participating on the exchange. What will happen in the coming few years is, as solar becomes more and more prevalent, during daytime there will be over generation, and at night there will be huge ramp up needed. This we have seen in California, where this is the data from the California's electricity board, effectively SEB equivalent. So similar thing will play out in country after country the world over, till the time we are able to solve the storage equation. So again, storage at small scale, we are familiar with lead acid batteries, with lithium ion batteries in our cell phones and stuff like that. But at scale, we haven't figured out how to do that. Various things are being worked out. So one is, to my mind, a very interesting thing where uh, in hydroelectric dams, you pump up the water from a lower level to a higher level during daytime when electricity is plenty, and you run down the water through the turbine at night when you need the electricity. So obviously there is some loss in efficiency and things like that, but still it's an effective way of storing electricity. There are various other technologies which are being tried out, but currently the most prevalent one where people are betting on is grid scale lithium ion batteries, where uh, Australia is trying out some of these, and some places in the US are working on this. In India as well, we are working on this. So these are news stories which have come out. Again, Ladakh, where a lot of work is going on the solar side. We are working on solar plus storage over there. Green hydrogen is again something on which a lot of work is happening. So in the past, we have not spoken so much about green hydrogen. I got interested in this space when I read coverage of Reliance's AGM, where they spoke a lot about green hydrogen. So try to figure out what this is. So solar electricity is fine as far as residential power goes, commercial power goes, transportation goes, or industrial electricity goes. But a steel plant right now would burn so much of coal, coking coal to convert iron ore into steel, or a cement plant will use coal. So how do you use renewable sources for industrial purposes? That has been a area where we seemingly did not have solutions, but apparently hydrogen can be used for industrial purposes. Uh, and if that hydrogen is generated by clean energy, then it is called green hydrogen. Currently, uh, most of the hydrogen is gray hydrogen, which is created using fossil fuels. But hopefully, sometime in the future, we will also have capacity to create green hydrogen. So that is uh, something interesting. So not just on the lithium ion battery front, but even some of the hydrogen fuel cell electric vehicles, there is some work going on. So lithium ion batteries work well for cars and stuff like that, but trucks have to transport very, very heavy loads, and battery vehicles may not be the best solution for trucks. So hydrogen fuel cell is a viable solution for that, and industrial uh, thing also works on hydrogen. So this is again a interesting space to watch out, and some of the bigger corporates in India are have announced plans to work on this. Reliance most notably. Uh, in the COVID year, we saw some setback in terms of rollout of solar panels, but that is picking up now again, and hopefully we'll be crossing the earlier peaks in the current year. Uh, so COVID was a setback, but I think we should be good and we should be back on track pretty soon. As it is, electricity in India is a mess because of subsidies and power theft and lack of proper billing and stuff like that. But with the coming of renewable energy, uh, there will be more chaos in the coming days, because the grid will have to accommodate these intermittent sources of power. Uh, Producers sometimes may get offtake, sometimes may not get offtake. And finally, do you allow people to set up rooftop solar at industrial scale? Uh, do you allow net metering and things like that? So, a lot of questions are unanswered currently. So when you listen to Todi Seba, everything seems utopian and everything will go like clockwork and transition will happen. But reality is a bit messy when you actually come down to the ground and try and figure out what things are happening. So there is this interesting report from IEA. You can access that uh, on their website, iea.org, India Energy Outlook 2021. So this is the composition of primary energy that we use. if we see large scale adoption of EVs, then this oil demand that is there could get converted to electricity, and that actually will put pressure on coal in the interim, not longer term. Longer term, solar and renewables will come in, but near term, we haven't invested in electricity generation traditionally, and we have had a big push on solar, but we haven't really worked out how to manage that intraday gaps. So, below 3 rupee per unit price during daytime and 12 rupees at night, we really haven't worked out how to handle that intermittent uh, nature of renewable energy. So, as and when electrification happens on transportation, then a lot of this demand could go away, and that could actually put pressure on uh, the electricity sector in India per se. So, right now, solar installations are ramping up, storage is severely lagging behind. EVs are here at very, very decent price points, and uh, for a country like India, more than what is happening to Tesla, what is happening to a company like BYD is more relevant, because those are at the entry level and mid level cars, and a lot of developments are happening in that space. And ironically, in the short to medium term, because of the huge underinvestment in traditional energy sources, that is a place where you could see severe shortages happening when all this demand comes about. So, just a couple of months back, I was in Gujarat, and although this is not the actual picture, but something similar was happening over there, where this huge truck was transporting one fin of a windmill to take it somewhere and install it. So, a lot of people think that all this renewable energy will manifest itself suddenly and we'll have a clean and green world. But to create so much battery storage, to create so much solar capacity, to create so much wind capacity, a lot of fossil fuel will need to be burned to bring that about. So, in the interim, actually, it will create so much demand for trucking and for transporting all of these things at the right place and the right time. Yeah, so this is a place where I think, apart from the internet and other things that we have been talking about, in the coming 10-15 years, I think a lot of change will be coming in this space, and uh, some people will create enormous value, and some companies may no longer remain dominant as they are today. Thank you. I'll take questions, whatever there are. No questions. This is amazing.
One second.
Okay, there is one.
As usual, excellent presentation, Rajiv. So I want to just ask you about the first part. You spoke about the logistics constraint led or the shutdown led supply disruption, and therefore um, there was price spike in several commodities. And but is there, I've observed that after 2 years of lockdown, where people didn't spend on a lot of stuff like travel, tourism, maybe clothes, weddings, so there is a surge in demand because of that. And I think that will also normalize at some point of time. So even that surge in demand is leading to some sort of inflation. The people are going out to eat, or so is there any data available on this?
So, Mr. Neelkant Misra of Credit Suisse, he's been writing quite a bit on this. So, maybe some of his media appearances or press articles would be interesting to read. He calls this the bullwhip effect, and this is spoken about. So, in COVID, there was a massive inventory rundown. All the physical stores ran out of inventory. After that, shoppers came back. There was no inventory. So stores started ordering for the current demand plus inventory which got run down during COVID, plus margin of safety. Let's keep some extra stock because so much demand is coming. So that created shortages elsewhere. Recent quarter, with some of the retailers, they have actually announced that now we have excess inventory. So they are discounting their stuff and actually selling at cost or at losses just to clear up the inventory. So that effect is very, very real. Lot of this pent up demand came in at one go, and then once that is satiated again, uh, things normalize.
Thank you.
So, Rajiv bhai, very good presentation.
Thank you.
I would like to ask you one question. So, there is a correlation between interest rate and inflation because central banks world over and including in India, they keep increasing interest rate. But I see somebody writing that many times inflation is not demand driven but supply shortage driven. So, what is your view on that, and what is the current situation according to you?
So the answer is correct that interest rates as such cannot do much about uh, supply, especially when supply is caused by external shocks. So no matter what European Central Bank does to interest rates, uh, the amount of gas coming in through the pipeline from Russia is not going to suddenly increase depend or decrease depending on how they tweak the interest rates. That shock is real. What interest rates can do is manage the demand. Uh, if monetary policy is too low or if too accommodative, monetary and fiscal policy. So let us say in India, oil prices are high. Now, if government and the central bank says we'll cut interest rates and give you oil subsidy, we will bear the losses and continue selling the oil at a cheaper price. What will happen is demand will not adjust to the supply shock. Demand will continue to remain elevated. We will keep importing at higher and higher prices, and the debt on the balance sheet of oil marketing companies and banks and all will go up. So interest rates typically adjust the demand. They cannot do much to adjust the supply. That is correct.
Okay, one last question. That recently I met somebody who was at one point in time head of research at Bearings. Now, I spoke to him for 10-15 minutes. I felt like I should jump out of my car because he was saying, "Sab doob jayega," and this interest rate scenario is real, inflation is real. You know, you should not get into the market and get into the bullion because I am very bullish in bullion. Not that he is a trader or anything anymore, but yes, he used to be very successful investor. So I was confused, and current today's topic, you said you don't subscribe to that view. So can you elaborate a little bit on that?
So finally, this is just a view that I have. Different people can have different views, and uh, most of the time, people keep giving all this gyan. Finally, no one knows what is actually going to happen. And uh, again, if we have a COVID round 2 or round 3 or whatever, or we have a China Taiwan war, obviously inflation will shoot up again because there will be huge supply shortages. So, a lot of these views are dependent on external circumstances. So the first part of the presentation actually was just to give a view that I have at this point in time, but things could change down the road. Rather than focusing too much on whether inflation will be there, not there, whether we'll have a recession, not have a recession, is it a bear market or is it a bull market rally or the start of a new bull market? Rather than focusing too much on those things, better is to focus on things which are more longer term in nature. So that's why I think first part, take it with a pinch of salt, accept the view or reject it. I'm perfectly fine. We can still be friends. I can still be friends with the ex head of bearings.
Or as an investor, if somebody says, now if somebody advises me and I have been in the market for so many years and he says now you should completely off the market. So how is it possible? I mean, you have to deal with this. You have to deal with high inflation. You will have to deal with the lowering stock prices or whatever circumstances that you face. So as a fund manager, how your mindset work?
Sure. So, firstly, to be an equity investor, one has to be inherently optimistic about the world. If everything is coming to an end, then maybe even the bank deposit or gold will not help. If a asteroid were to strike Earth and wipe out life, or if everyone goes into a nuclear war, then no matter what asset you have, it doesn't matter. So that is one. Second, it depends on the time horizon. Uh, if you have an asset purchase coming in 1 year or in 2 years, I would agree with your friend's recommendation. Reduce your exposure to equity, be more in short term debt instruments, or maybe even have some small allocation to gold or whatever. Uh, so, if you have if someone is a 25-year-old or 30-year-old who's recently started working and has another 30 years of working life ahead and to save for retirement, then I don't subscribe to the view that you should be in cash or you should be in bonds or something like that. Then one should be equity heavy because one has that longer term time horizon. And even if there's a recession or there's a cycle where interest rates are somewhat elevated, one can ride that out.
Yeah, Rajiv, China factor is also at play. And we read a lot about China slowing down and mainly the real estate story. Recently, it was in media where the China economy is mainly driven by real estate and the real estate is like collapsing. So, what's your perspective on this? Because ultimately, the world demand will come down. And secondly, USA, even before pre-COVID era, this USA had been printing money, and most of that money was ending up in China and creating, consuming Chinese goods being consumed by USA. So, what's your perspective on all these? How do you see these things playing out?
Real estate slowdown in China is very, very real. There are projects which are stuck. Recently, something went viral in China, and considering the extent of state control over there, this was very, very surprising. Where people made this a viral thing that stop paying your mortgage loans to the banks for stuck projects. So, if I have booked a flat and I have made a part payment and I've borrowed money from the bank, if the builder is not giving me my flat, I will stop paying the bank and force the government to complete the project or bail it out. So, this thing went viral. A lot of people started protesting and things like that. So, now various local governments are bailing out projects and taking some of the debt on their books and stuff like that. So, uh, real estate real estate in China is slowing down. That is a fact. That has resulted in cool off in various commodities, most notably iron ore and steel. Uh, Will it affect demand? Yes. So not just real estate slowdown. China, very surprisingly, even after a passage of so much time, is still following the zero COVID policy, because of which they find a few cases and they lock down entire cities, and that is creating massive slowdown in the economy and production losses. Uh, yeah, so when will that end? I don't have an answer, but people are seriously working on uh, de-risking from China and moving some supply chain elsewhere. So I think yesterday or today's Wall Street Journal article, uh, iPhone 14, the newest iPhone, uh, earlier there used to be a big gap of time between when China started manufacturing and India started manufacturing. They are reducing that time very, very significantly. So they have a second supply base in India if there is a problem with China. So you will read about it in the papers in 1 or 2 days. Uh, a lot of people are working on de-risking their supply chains. Uh, yeah, those are unknowables. I don't have a strong answer one way or the other. Overall, I think things will ease out in terms of supply shocks and all. Overall demand in commodities is overdone. We are already seeing the mean reversion happening. Uh, for So one can't have both, right? You cannot have continuously high interest rates and high inflation, and at the same time China slowing down. So either China will pick up and inflation will be high, or as commodity demand cools off, energy demand cools off, overall inflation will come down. Luckily, in this current whole environment, impact on India is only peripheral. We are not directly in the war zone like uh, Eastern Europe or something like that. Our foreign exchange reserves are comfortable. We are not having real estate problems like China, or we are not now following the zero COVID policy where we have huge lockdowns. Our production linked incentive scheme is working in some sectors. So, broadly, the environment is good for India if overall things don't go too bad. Banking sector is doing fine in terms of their balance sheet and cleanup of past bad loans and stuff.
Hi, thank you for the presentation, Rajiv. Uh, as an investor yourself, or in general, how does one think about the interplay between long-term and short-term trends? You highlighted the energy transition, and you mentioned the long-term trend and also something in the short term. You can see that playing out in a lot of component manufacturers, auto components to be specific. So, how do you think about it, or how should one think about it?
So very, very short term, I don't have an answer. I don't try to predict things on weekly, monthly, 6 monthly basis, 1 year basis. Medium term, I would say 3 to 5 years kind of thing, and longer term is decade and more. We saw uh, things like fossil fuel where there are shortages and energy prices have gone up. So although one can subscribe to the energy transition thesis and say 10 years from now, our reliance on fossil fuels will be much lower. But if there's severe underinvestment in that space and if valuations are very, very attractive, then you could have investment in that space for a 3 year, 5 year period or something like that. So you can have a view which on a multi-decade basis is somewhat negative, but given that valuations are very, very compelling, cash flow is there, and medium term outlook is not that bad, one can invest in that. So, most notable example I can give of another famous investor is let's say everyone knows that newspapers are overall seeing a decline. But Buffett has bought quite a few newspapers purely because cash flows have been good and stuff like that. So one of you can have a investment which is contrary to the overall macro theme if the valuation has enough margin of safety built in.
Rajiv bhai, hi. Interesting presentation. You mentioned a point like, say, for example, there are certain trends that even during the transition, they are there for longer term. So, in this transition, what are the trends that you see are going to, persist for even through this transition for a longer term? And in this transition, secondly, what are the trends that have, picked up an accelerated pace in according to you in last 1 year, 2 years or so?
So one of the trends that has been there has been rupee weakens 3% odd every year, and that has been happening on an average for over decades. If in the medium to long term we are able to reduce reliance on imports of energy, if that one piece goes out of the equation, if the production linked incentive schemes start working, and that seems to be working in various sectors, especially things like electronics manufacturing, some of the auto components and things like that. So that reduces import dependency. Education, which is a big item of remittance abroad, we have opened up uh, private universities and increased the domestic supply. If those kind of things change, then currency weakening, which was a perennial feature in India, that changes, and that could impact some of the export oriented companies, and uh, that could change the equation. Geopolitics, I mentioned, the currently energy rich countries have a disproportionate share of power in the world that could uh, change over a period of time. Uh, People who have energy as input into their manufacturing process, that cost could theoretically come down, because what was happening is, as we go to as we burn the cheap and easy fuel, you have to find more and more difficult fuel to burn. Uh, just to give context, uh, crude oil without impurities is called sweet crude. Sweet crude means it does not have uh, impurities like sulfur and all, right? And crude oil, which has a lot of petrol and diesel kind of components, is called light crude. And uh, crude oil, which has a lot of industrial energy, is called heavy crude. So light and sweet crude is always better, and that is what people explored for first, and that is what people started using. As the light and sweet crude wells started running dry, people went to heavier crude, and when crude is very very expensive, people start exploring Canadian oil sands and things like that. Uh, Shale gas is a different thing. That's environmentally friendly. That was actually a technological innovation as to uh, how to extract gas from uh, rocks, which is trapped under the rocks. So any natural resource has limitations of geography and is constrained. Anything which is technology led, where you are creating things like solar panels or battery storage, then once you set up the infrastructure, the energy keeps getting generated. Then you don't have a problem of that. So people who use energy as an input into their production process, they benefit from such a thing. These are some of the things that could play out.
Yeah, we'll just take one question from the live audience here and we will go back to Zoom audience if they have any question.
Hello. So, what's your view on the US dollar? The US dollar has been strengthening a lot, and mainly one of the reasons is because some countries, which are the components like Japan, which is not raising the rates at all, keeping the rates low, and also in Europe, the interest rates have started raising last few meetings, even in UK. Eventually, they will also feel the heat of inflation in Japan, and they'll also start raising the rates. So US dollar shouldn't be so strong. How long you think that this situation can stay, and what is your view on the dollar? And that is also the reason when you showed the charts on commodities like copper and all, since they have an inverse relationship, the commodities have come lower.
Sir, short answer. Unfortunately, I do not know, or I don't have a strong view. So I'm not a macro person, or all of these things do not have a big role in terms of the investing that we do. So although we invest in foreign stocks, most of the currency exposure we hedge using futures contracts. So I don't have a strong view on dollar euro, dollar yen. It's a fact that dollar has appreciated against uh, most major currencies. My only reading of the current environment is we are in the midst of mean reversion. Uh, the charts that I showed, almost universally, I see things correcting from the peaks that we had seen in the past. So, some sort of mean reversion is happening world over, where I don't see a runaway inflation kind of scenario based on the data points that are coming in. That's a limited reading. I know it's not a very satisfactory answer, but I don't have a very strong view on this.
We will take questions from the Zoom audience if you have any. Mr. Kirit Modi had again mentioned about rupee depreciation, and he said that some people feel that it is a good thing. It's a high time that rupee should appreciate. What are your views on that?
So, as long as we are in a trade deficit scenario, uh, rupee would logically depreciate. Once we are able to solve for the import dependence, so where do we spend money? We spend money on oil, we spend money on gold imports, uh, we spend money on foreign travel, uh, we spend money on electronic imports, education. So imports we are trying to address by production linked incentive. Sector by sector we are trying to reduce import dependence, things like edible oils, palm oil, and uh, things like coal imports and all. We are trying to increase domestic production. We have modified our education policy where a lot of high quality private universities are being set up in India. And if the energy transition happens, this chronic trade deficit scenario for India gets resolved. And if that gets resolved, then rupee will no longer weaken. But till that time, I think structurally, uh, we have a situation where we are importing more than what we are exporting.
Any more questions from the Zoom audience before we conclude? Okay, I guess not. Thank you, everyone. Thank you, audience on Zoom, and thank you, audience who are present in person. Thank you so much, Rajiv.
Thank you.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.